Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
We'll see about whether there is, in fact, a slow bank run going on in the ranks of private credit currently. Some of the subtopics for this week: inflation hitting some turbulence. We've spoken a lot about inflation and how the estimates for the longer term inflation were still more muted, even though in the short term there was deemed to be a more transitory influence of the price of fuel, as well as fertilizer and other food even. We also think about interest rates, and in the imagery of the Artemis 2, whether interest rates are indeed coming back to earth after briefly being derailed as inflation seemed to be higher. We will look at equity markets and some of the subtle shifts that are taking place within equity markets. They are not behaving as they have behaved during previous crises, and that in itself is notable. We will look at AI, trust, as well as in geopolitics, the impact of some severance of trust and how that may well be the precursor for deglobalization 2.0. And as mentioned before, private credit has really become an exercise in crisis communications. Starting first with inflation expectations. So clearly looking at emerging markets first, we know that emerging markets seem to be very much in the crosshairs due to their dependence on oil sourced from the Middle East, that the conflict has seen their CPI forecast undergo a sharp course reversal, with inflation that was heading very much south of 2.7%, now up higher to 3%. The inflation expectations are significantly higher in the US too, and than they were before the war started. So we now see inflation expectations and how that reflects on interest rates. We see now that interest rate expectations are a good 25 or 50 basis points higher than they were before the outbreak of the war, and they're continuing to tick upwards. We know that the inflation expectations are also higher. However, as we showed last week, that is a short-term expectation. The expectations for 2027 are still significantly lower. When it looks as I mentioned, this is seen as being a transitory shock effect, not expected to last longer than 1 year. If we look out on the top in the chart on the top left, the 1 year inflation swap, the 2 year inflation swap, we can see that the 2 year is south of 3%, whereas the 1 year inflation swap remains above 3%. So clearly coming down in the long term. We have spoken before about the long-term deflationary forces that are likely to impact that. But in the short term, still the shock of particularly in the US, the price at the pump. We can see from the price at the pump that is gas prices that are expected to take the US headline inflation back above 3%. And we know that the inflation there has been increased and higher than 25% after languishing at very low volatility for many years at the pump price. This average pump price of above $4 a gallon in the US, that is a very important symbolic threshold. And once that threshold is passed, the consumer, particularly at the low end, really starts to feel that pain. Moving to general economic vibes, we can see that the markets reacted very positively to the ceasefire announcement on Tuesday evening, after expecting the worst, quite frankly, as the rhetoric around escalation built. And they are now working on the assumption that the war has essentially concluded. If we look at the top left, looking across the S&P, the Stock 600, FTSE Emerging, right through to Japan, we can see that there has been a significant rally just in the aftermath of the cessation of at least explicit escalation rhetoric, and that is a suggestion that markets were really waiting on the sidelines for some clarity here. They clearly prefer the certainty not to have the disruption to supply chains and energy supplies that we were seeing in the Gulf. And that has been very positive news. The fact that they were poised to rally just on that same piece of news suggests that there was money on the sidelines, risk on appetite still in place. And as we'll see later, a slightly more nuanced approach outside the US, but certainly in the US, a positive approach to risk. And that was also reflecting in positive movement in the US dollar. Final chart on this page, the US stocks had resumed their ascent compared to bonds. We can see that the The stocks had been ticking downwards relative to bonds, and now they are again in the driving seat. Let's think about the other aspects of the current vibe. I'd say there has been a certain normalization of at least the geopolitics around conflict. There has been an expectation for day by day updates on that, and the fact that the markets have still remained so resilient suggests that they have now taken some of this in their stride,